We're jumping right into a financial analysis report on VMAR stock. It's proposing a reversal strategy after a massive 52% crash, all based on an arbitrage opportunity against the $30 institutional price.
A classic, high-stakes setup.
It is. Okay, so the core essence of this VMAR piece is really about finding opportunity in, extreme volatility. The analysis report builds a case for a pretty swift rebound, and it's built on what I see as three main pillars. First, you have the catalyst. The huge dilution from the offering, that's what caused the crash. But the company also secured $9.6 million.
Which takes immediate bankruptcy off the table.
Exactly. And that's what justifies this idea of value buying. Then, the second part is the technical setup, which the whole strategy really hangs on.
Right, the key price points.
The analysis report defines two of them. The floor at $0.23 to $0.24, which it says must hold, no exceptions, and then the magnet at $0.30.
The institutional price, the price the pros just paid.
That's the one. So the objective is pretty clear, a targeted 25% gain by riding that momentum back to the institutional entry. And the after-hours jump to $0.28?
That's the validation.
It's the validation. It suggests smart money is already agreeing with the thesis. I can absolutely see what the analysis is aiming for here, but it's the tone.
Ah, yes, the tone.
It's deliberately high energy, contrarian, urgent, and that gives me some pause. It's a phenomenal hook, no doubt. Trading below the entry point of sophisticated investors is, that's the dream scenario.
It is. But I have to wonder, is all that enthusiasm actually serving the underlying technical logic?
That's the question.
So I think the choice of an overly urgent and, let's say, hyperbolic tone, like framing the situation as hype mode, it actually risks undermining the critical, logical foundation of the entire analysis.
Right. It feels like you're trying to sell me on the trade emotionally, not just logically.
Precisely. We're looking at a 25% upside, which is genuinely exciting. But when you use language like the biggest gift the market has given us, or you suggest the strategy is based on a secret nobody is talking about,
it cheapens it a little.
It diminishes the credibility. It makes it sound less like a robust piece of financial analysis and more like, emotional speculation, not conviction based on market mechanics.
And that's the core weakness, isn't it? The tone feels like marketing for a trade rather than an objective analysis of an arbitrage opportunity.
Exactly. The hard work of laying out the facts is done. Now the presentation needs to match that diligence.
That's a great way to put it. It's tough, though. When you find a trade that looks this clean, institutional entry below the current market price, the urge to inject that drama and urgency it's really powerful.
Of course. But in these high-stakes situations, conviction that's built on calm certainty is always going to be more powerful than passion built on adrenaline.
We need to channel that enthusiasm into clear evidence.
That's the suggestion for improvement here. Recalibrate the language. Move it from urgent speculation to data-driven conviction. The logic is sound, so the language should reinforce the analyst's command of the facts.
Competence, not just excitement.
Yes. Think about swapping some of those high-energy phrases for more precise, confidence-inducing statements. So, for instance, instead of describing the drop as pure panic, which is all emotion,
you could reframe it.
You could state that the 52% drop represents a pricing dislocation based on, clear historical institutional entry points. You're immediately grounding the contrarian view in quantitative terms.
The difference in how the analysis is received there are huge. One invites speculation, the other compels agreement with a fact-based conclusion.
Absolutely. And I'd suggest removing any instruction for hype mode entirely. Just focus on a clear, objective delivery of the opportunity. That shift transforms the whole thing from a passionate pitch into a strategy.
And that builds trust, especially with a stock that's taken such a beating.
If you present this level of volatility with a measured hand, the reader instantly respects the authority behind the analysis.
I agree completely. When you're making a contrarian call on a stock down 52%, the foundation has to feel rock solid. It needs calm authority, not adrenaline. And that idea of calm authority is, it's exactly what's missing in the next section, the risk assessment.
Right, for a high-risk play.
For a play explicitly labeled high risk, high reward, this analysis feels strangely, incomplete on the risk side. So let's frame the first big issue this way. For a strategy explicitly labeled as a high-risk, high-reward volatility play, the analysis report must dedicate significantly more focus to quantifying and managing the downside risk.
It's unbalanced.
It's completely unbalanced. The weakness here is that the strategy is almost 100% focused on that 25% upside. The downside risk assessment, which is mandatory for a stock that's crashed this hard, is just minimized.
It just says the floor has to hold.
Right. It establishes that 0.23 to 0.24 range is the line in the sand, but simply saying we need 0.23 to hold is just not sufficient. It doesn't explore the concrete, quantifiable consequences if that line breaks.
And by not defining a clear protocol for failure, it leaves the reader really vulnerable to confirmation bias.
That's a lethal strategy.
It is. The reader's basically incentivized to hold on past that technical failure point, hoping the magnet still works, which in these volatile stocks is a recipe for disaster. A responsible analysis has to map out the potential for loss. Yes, both of the risk management section clearly define the expected percentage loss if that 23-cent floor fails. The analysis report needs a specific exit or reevaluation protocol for that negative outcome.
Give the full risk-reward framework, not just the reward part.
It shows the writer has done their job, regardless of the outcome.
Right. It shows you've mapped out the worst-case scenario. And we can do this in a few ways. You could include language that defines that downside in quantitative terms. Something like, a sustained breach of 23 cents invalidates the reversal thesis, requiring a mandatory stop loss to protect capital from further erosion towards X.
And you could even assign a percentage loss to that.
For instance, you could model a scenario where that $9.6 million cash runway is shorter than everyone thinks.
Right. What if they need more dilution?
And explicitly outline how that scenario immediately impacts the viability of the 0.30 magnet. Showing you've considered that turns the floor from just a hope into a calculated line of defense.
And building on that point, the whole thesis rests on the idea that the institutional purchase at 0.30 was rational, right?
Correct.
And that rationality is based on the idea that this cash infusion makes the company fundamentally safer. This is where we need to connect the dots more clearly.
Between the money and the operations?
Exactly. The thesis relies so heavily on the technical setup, that strong 30-cent magnet, but it really needs to strengthen the connection between the $9.6 million catalyst and the company's projected operational longevity and value creation.
The weakness being the generalization.
It's all generalization. The report just summarizes the use of funds by saying VMAR has money to build their engines. I mean, that's far too general. It lacks the substance to justify the claim that the company is truly de-risked.
It's the difference between saying they have money and this money solves problem A, which allows goal B to be met. The write-up assumes the reader understands why this specific amount justifies that institutional valuation, beyond just the bounce from fear selling.
Right. If those institutional investors paid 30 cents, they must believe this cash enables specific, definable outcomes that support that price.
That's the essential link that's missing.
And that's the improvement. The analysis report has to integrate specific, context-rich details about how VMR is using that capital. To make the argument truly robust, you need to outline what milestones or goals that $9.6 million is meant to fund.
You're translating a financial relief event into a fundamental business opportunity.
That's how you bridge the gap between a quick technical trade and a high-conviction investment thesis.
And we can do that with concrete data. For instance, the writer could add a specific reference that anchors the cash raise to production goals. Instead of just build their engines, try something like, this $9.6 million is estimated to fund operations through Q2 of next year, allowing for the scaling of product X prototype testing.
That's a crucial de-risking step. It's tangible.
It's tangible. Or another strong example would be specifying the exact problems being solved. Something like, the capital specifically targets the elimination of supply chain bottlenecks identified in Q3, which is tied directly to their ability to deliver on prior commitments.
See, that level of detail validates the institutional entry point. It gives the reader confidence that the 30-cent target isn't just a technical phantom, but a price that is fundamentally supported.
And that depth is what will elevate this entire piece.
It really will. It takes the VMR strategy from an interesting contrarian story to a comprehensive authoritative analysis that commands respect. The structure's there, it's fantastic.